Right, so I usually don't do this. I usually don't mess with sim when I'm doing a combine because, there's not much difference really. But just to consolidate my knowledge and rather than break a rule and get in after the open, which I'm just not going to do, I decided to go on to sim and do this. So as you can see, I'm up 2R in this sim trade, and I got short at 79, which is where the order flow confirmation was. And you can see we hit that to the tick and bounced off of there. So I'll just walk you through the trade so you can get an idea of what I'm doing and maybe apply some of this to your own trading. So the backdrop said flush, and we won't get into that because it's beyond the scope of this video, but the backdrop was suggesting that there needed to be a flush. So when I was seeing this activity like this, and we got order flow confirmation here, the flush is going to come in the form of a head and shoulders, or what I call more specifically an appendix, whereby you get a deviation from a certain type of price and then you come back into that price and continue as if you had never left that price formation. So in this case, the price formation is like this: choppy, overlap. If you study the character of the bars, you've got lots of wicks and overlap. And the color of the bars as well. You've got some reds and you've got some greens. So you've got some up candles, some down candles, lots of overlap, lots of back and forth. Then suddenly, if you look from here onwards, you'll see that there's a shift in market sentiment or structure. You've got less overlap, less pullbacks, more bars that are of one or another color. So green all the way up, less overlap, less wicks. A sharp pivot off of this area, which was the area I was looking for, 85. It's not necessarily going to hit that all the time, but you're just looking for the zone rather than the price. And that then came down with red bars coming back against with little to no overlap. And then we came back in, and this is the what I call B of the appendix. Here's A and here's B. And that is, when you get a wick here, that is the first time that you have confirmation that this may be an appendix and a return to the prior price action, which is this. So this section here is just a blip to get out stops and initiate new longs and take out some early shorts, such as me today. Take out their buy stops and get in some new long participants up there. So that's something to bear. As I said in the last video, you need to watch out for thin markets, and absorption can occur on the offer in this case. So lots of people were hitting the offer and not lifting the offer here, as you can see by the wicks, and so that suggested downside. But as I said, we hadn't had the flush up to this magnet up here, the 985 magnet. We got that, then we got more buying here, so I'll show you that in the form of, we had more buying here. If I look at this, this is filtered for 5 or more contracts, as I said in a recent video. And if you go back to this time here, 2:30, you will notice, I think it's gone off the page now, so we can't see that. Let's have a look at the filtered for 10. Filtered for 10 and above, we cannot see that either. So unfortunately, the information's gone, but we had a clump of buy orders, buy limit orders, or buy market orders here that went to market and got executed. So lots of buyers executed here. Now when you see the wick here and the wick here, that's rejection. So those buyers are now trapped, and there came the ensuing move. So when I saw A here, the clump of buy orders will be my proposed area, my hypothetical area to get short against those early longs, or those breakout longs that initiated their long position here and got caught. So as it comes up to their price, you want to, they are going to sell to you, and you're going to buy to cover later when you sell. So you, let's see if I've got that right. They bought here, and their stops, their sell stops are going to be under here. So you want to sell short along with those people who are selling short, who are selling to cover their longs. That's what I wanted to say. They bought, naturally, if they're intraday traders, their sell stop's going to be somewhere not too far underneath. And as we move up into that area and they initiate their selling because they are trapped, when you see wicks here, that means they're exiting their failed long positions, and you ride down with them, because some people are going to have, the intraday players are going to have smaller stops, and then the more intermediate players are going to have larger stops, and then perhaps position traders, day traders, and people who are swinging may have their stops even lower, like under this low or under this low. And so these are all stop triggers on the way down from people who initiated their buys here. So that's the long-winded explanation. I'm finding a lot of use. In case anyone's interested, what I'm studying is, let me see if I've got it here. What I'm studying is, I'm studying jigsaw trading. So if you Google jigsaw trading by Peter Davies, he's a British guy. I think he resides in Thailand now, if I'm not mistaken. I've been studying hours of his material, and this is what's really helped me. But a caveat emptor, if you introduce order flow to your trading, expect it to mess things up in the beginning if you're not careful. Because as I said, if I wasn't relying on order flow and I was just looking at my flush pattern, you know, on the higher time frame, and looking at my prior analysis, I would have been more inclined to skip this short that I took, as you see in the prior video, and I would have been more likely to wait for this one, because that's exactly what I was looking for. I was looking for, once again, I was looking for an appendix, and so I was looking for a change in price action. I didn't see one here. There was no reason to short there. And then when you saw this action here, it takes a bit of practice, but once you get used to it, then you'll be able to see real time that if we do bar by bar, and you keep doing bar by bar, you know, you'll be able to recognize the change in price structure. So at this point here, the volume, the numerous green bars, the relatively low amount of overlap tells me that that is the flush. And then I would have simply shorted that shooting star there rather than waiting for order confirmation. So it's yet to, I've yet to quantify whether this is actually going to help my trading or not. But for now, I'm going to go ahead with the plan and continue to lean on the edge that I've got in terms of keeping my trading towards the morning hours here in Central European time, and avoiding all instruments except YM and potentially maybe 6A, as that is profitable for me. So let's have a quick look at 6A and see what we may or may not have done today. There's a long here from 339, and that went to 357, so $180 there. And then potentially, if you were to get this one down here, you would need order flow to get in, as there's no reversal candlestick. But again, there's my appendix and volume and pace analysis. So you can see an appendix here because we had smaller bars and a bit more overlap, and then one big bar down. Then we had the wick against, so resistance, support became threatened to become resistance, and then that broke with a close, and then a gap. From this close to this open, there's a little gap. So the combination of the gap and the chopped and up meant that we could then expect that to hold as support when it came down, if, and I'm only guessing, if there's either a reversal candlestick here and or order confirmation. And so you'd be long from somewhere down here, I would say 32-ish, and you could have got to 45 and beyond for your 6 ticks risk. So a 2 to 1 there, and probably like a 3 to 1 here is what I would have done. But I'm ignoring that. I'm ignoring trading after, trying to do the discipline thing, and ignoring the YM. Obviously, I would have just taken this in the Top Step Trader account, but I'm sticking to my guns, and we'll see if this is going to give me a positive result by Friday. So I'm going to pause this video now, and we'll see how this plays out. So this is the sort of thing I'm I'm looking at doing, to give you a working example of what's going on here. I'd be looking for example, if we go down here, we see a whole bunch of buy executions down here, a 10 lot, a 12 lot, another 12 lot, 5, 8, all stacked at 59. So that's here. And they all occurred in this candle here. So at some stage in this reversal candlestick, after a little downtrend, we had lots of buy market orders execute at 59. So there is strong buying there with a reversal candlestick. Then later on, 43, so this is still within this candle. Here we had a 20 lot execution down at 55. So lots of buys. You would expect the market to go up from here. The trigger point of this candle is going to be 964. So you got to watch for what happens around that level. So if you notice here, 964, 63, 62, 64, we had some sells here going against this upwards bias via order flow in the candle. And what happens after is key. With this such a big reversal candlestick and like follow through, no follow through here. So we've got a wick above the trigger of this candlestick. It suggests that there is still selling. Now, of course, it might not work. It's not an exact science, but my bet is we would continue down from here. If I were in this market, or if I were actively managing a position other than all in and all out at targets, then I would be looking for a continuation of the trend back down from here based on this order flow information here, because we had lots of buying and then a wick above the trigger of this candle where so much buying occurred is going to get all of these buyers nervous. So I'll pause the video and let's see if indeed we do get a move down from here. So I would be looking, maybe it's going to tick up a little bit more. That's where the unfiltered order flow, the unfiltered footprint time and sales comes in handy, because it will suggest, it gives you a feel for momentum to complement the bigger orders and the bigger order flow. So if we look over here, we see lots of blue, means lots of people hitting the bid to sell market orders, meaning they're eager to sell, and we watch how price moves up and down. If it moves up like molasses on a clump of green orders, but down very quickly on relatively fewer blue orders, meaning hitting the bid, then we know that momentum's fading. So looking at, I'm not an expert at this, I'm not an expert at any of order flow, but especially not the unfiltered side of things. I do have more of a grasp of the larger orders, so 5 and above and 10 and above. That's easier to use. So you can see here we've had a little 6 lot come in just now, because it is 15:54. And the wick's still holding. In 30 seconds this candle will close and it will be another wick. So looking over here, we see, are we seeing moves down when we see lots of blue, lots of hitting of the bid? Are we getting movement down? And are we getting relatively less movement up with clumps of green? So yeah, so I will pause the video for now and then come back on to see what happens to this trade. So it's some 2.5 hours later, and as you can see, the 44 target was hit, and that has become pretty much support to within 8 ticks of wiggle. So I'm pretty good with the targets, pretty good with the entries, but what I need work on is having the confidence and or know-how to get out of either the emotional fortitude to completely avoid the trades that are retail, such as this short here from 69 with that target in mind, and just get the first entry and hold through all of this, which is very emotionally difficult to do, but possible. So if I had shorted here at 79, my 89 stop would have held and I would have got to 44, and that is a 3.5 hour target. So that's a possibility. But an easier way in terms of the emotional ride, and also a more profitable way, would be to be able to get in these retail entries, scratch them for a profit, or break even or a small profit, and then reposition, and assuming there were some order flow reversal signals here, get out here and reposition again. And so either do that once, even if you just did that once, you'd have earned an extra half hour here on top of the 3.5 hour. If you were to get in here and get out here and reposition anywhere with this stop in the original place, then you would be able to make obviously more than the distance between entry and exit. So you might make an hour and a half or 2 hour, let's say 2 hour here, and then 3.5 down to the target, using order flow to get out and get back in. So that's going to be my plan moving forwards, and I think what I'm going to do is I'm going to do jigsaw trading's cut and reverse drill, which isn't really their drill. It's a drill that many proprietary trading firms, prop firms, use to get people up to standard in their order flow analysis. So I think that's what I'm going to do starting from today. Essentially, you just need to have a dome. They advise you to use their jigsaw trading software, which shows more information, depth of market, and trades going off on the bid versus the offer, market profile, and all that stuff. All I'm going to do is I'm going to use my time in sales in conjunction with the dome and have no charts, and essentially you've got to put a contract on, where is it? Yeah, you take a position of one contract, long or short. After that, you must stay in the market for the full 60 to 90 minutes. I'm going to do 60 minutes tops. You got to do this for 10 sessions, and you can either stay with the market or reverse the trade, but you absolutely cannot go flat, and you cannot restart either. And then we want to see where we are after 60 minutes of staying in the market and going long and short without stop based on what you see in the order flow and the footprint. So that's what I'm going to do, with the goal of being able to have the conviction, the knowledge and the conviction to be able to get in this trade. Because it's difficult. What you could do to avoid all this is just get in the high odds probability wholesale entry, but that's extremely difficult to do consistently. And so on a day where you say, well, I'm going to take a shot at a retail trade, it'd be nice to be able to have the know-how and confidence via your order flow trading skills to be able to get out with some profit and reposition, knowing that you would have been stopped, because a common situation is the retail stops near the highs. You could have, whereas you could have made a bit here, then made a lot there, you just lost a bit here and didn't get in because you had just been stopped out. So these are the sorts of games that cognitive biases and things can play, and these can be avoided by being more nimble and being able to reposition. So I'm going to do this drill, probably the first one today, and I will upload them to YouTube at high speed so you can see my result. I don't expect the first one's going to be anything pretty, but that's the goal. The goal is to improve. So I'm going to do 10 times 1 hour sessions and take notes and study them, record them and then study them. So I'll leave it here for now. So today's box score would have been the one stop plus this gain, so I would have been up like 116 or thereabouts, 115 after commissions. But I am down 1 hour or $53.68 today. So that's it for this video, and I'll be back in the next one.